Hi, everybody. This is Anand Sanwal from CB Insights. We're going to jump into the presentation around innovation and how corporations can use startups to innovate faster. A few notes. If you are tweeting, you can just tweet at CB Insights and use the hashtag Corp Innovation, as you can see here. Um, with that, a little bit about myself. I'll let you read this. This is a topic that's pretty near and dear to my heart. I ran American Express's Innovation Fund prior to starting CB Insight, so have seen this from both sides, one as a practitioner and now working with lots of our clients and subscribers to CB Insights, helping them kind of enable this. It's something I think I know a little bit about and hopefully have made some mistakes and done some things right, and we'll be able to share those with you today. For those of you who don't know CB Insights, our sort of fundamental kind of underpinning and belief is that some of the largest decisions that corporations make today uh, often too heavily rely on gut instinct and Google searches. And so things like the next market you should expand to, or your next M&A target, or what your competitors are doing, um, again, rely a lot on anecdata. And so we're trying to bring data and rigor to that using our software, data, and algorithms, and really with the goal of helping you see the opportunities of tomorrow today. We are fortunate to work with lots of the world's leading organizations, and you can see a few of those here on this slide, and there's many, many more. And so with that, I'm going to jump in. We're going to cover a lot today. I have almost 100 slides to go through in the next 40 minutes, so we're going to go pretty quick. First, we're going to cover the faster pace of disruption, kind of just talk about why things are different now in terms of the pace of disruption and innovation. Two, kind of tongue-in-cheek, talk a little bit about what we see sometimes when big corporations try to innovate, and it is innovation sort of in theory or in kind of innovation theater, as we call it. Third is sort of a little bit sort of philosophical in terms of your approach to talking and thinking about startups. We'll think a little bit about that and talk a little bit about this yes and approach, which will make a bit more sense when we get to it. Step 4, part 4, we're going to really talk about the process to try to create sort of a net to catch startup innovation, and then finally conclude with some statistics around, whether you should build, buy, or partner, and what has worked and what doesn't work for organizations. So with that, we're going to start with the faster pace of disruption. Really the idea here being that what got you here won't get you there. So I guess it's worth defining, since we're talking about startups, as a way to innovate faster, defining first what is a startup. And luckily there's some very smart people who've done a nice job doing that. We have Steve Blank and Eric Ries. And so I'll let you read these definitions. I think the main sort of key takeaways here are that this idea of them being temporary or working in sort of extreme uncertainty is really important. So when you kind of boil these definitions down, startups are really just ultimately experiments. And so for you as a corporation, they are outsourced R&D, right? So you have this petri dish of different startups that are trying things, different business models, different demographic segmentations of clients they're going after, different marketing tactics. And so you get to sort of get a bird's eye view into what's happening. So, and in the last 5 years, there have been almost 38,000 early stage experiments that have happened. We're just talking about kind of seed and Series A, Series B stage companies. So there's a lot of experiments that are happening. And so as a corporation, these are, kind of that outsourced R&D that you can look to for ideas and inspiration. The reason these startups are so important is because these emerging business models and startups ultimately become tomorrow's problems. And so this is Clay Christensen's kind of famous disruptive innovation framework. What you see here is products and services that are at the low end of the kind of low quality use end of the spectrum in the beginning, move up over time and increase performance, and eventually become able to handle a lot more demanding use cases. So people will point to eBay as an example. eBay started off, I think, as Beanie Babies, as it was sort of well documented, and then ultimately moved up into cars and art. So what was a trivial sort of fringe use case eventually became much larger, and a lot of technology companies start in a similar fashion. The next slide kind of shows just why it's so important that organizations think very proactively about innovation. So what we see here is the average lifespan of a S&P 500 company over time, and it's pretty clear that the lifespan is declining, and so it is, again, just harder to stay on top once you're there. Part of the reason for that is that the threats to incumbent organizations are multiplying. So in 2000, during the first dot-com boom, kind of the cost to launch a startup was almost $5 million. I worked at a startup at the time called Cosmo.com, which is one of the more famous flameouts in New York City. We raised hundreds of millions of dollars, and a lot of that was going to servers and infrastructure and routers and other things and switches. Today, a lot of that has been kind of extracted, and now because of AWS and Microsoft and Google and cloud services, it's incredibly cheap to start a company. And so this was some great data put together by our friends at Upfront Ventures that kind of highlighted this. And what we're seeing also, in addition to the cost coming down, the adoption curves when it comes to technology are quicker than ever. And so this is a great chart that was in the New York Times that looked at technology and its level of adoption over time. And so take something like the telephone. So if you look at this chart, starting at 1900, the telephone took almost 100 years to get to 90% adoption. So just follow that sort of dashed orange line. And then you look at things like the cell phone or internet in 1990 and later, and you see how quickly they've become kind of ubiquitous within sort of the US population. These trends are sort of global in nature. We see it happening within business models. This is a great example of Charles Schwab versus Wealthfront. So Wealthfront being one of the robo-advisors, as they're known, getting to $1 billion in 1/3 the time of Charles Schwab. Betterment kind of bested Wealthfront and got to $3 billion in assets very quickly. So it's it's technology, it's business models that work really, really fast today. Even amongst fast-growing companies, the speed is increasing. So here we're looking at WhatsApp versus, companies like Facebook and Gmail and Twitter, which grew incredibly quickly. Even there, the pace amongst sort of the elite is even kind of reaching pretty phenomenal levels. One of the things that I think we hear sometimes is, well, this is interesting, but this is a tech phenomena. That's really not true. When you look at Airbnb, it's sort of tech-enabled, but ultimately what they're going after is a traditional industry in terms of lodging and hotels. So here we're looking at kind of valuations over time, and whether you argue about Airbnb's valuation being justified or not, the reality is that it is clearly changing kind of how people think about travel and how they think about where they're going to stay when they are traveling, and that is a direct threat to incumbent organizations like Marriott and Starwood and others. Again, in the vein of it not just being a tech industry thing, here we see Hellmann's, which is a brand owned by Unilever, suing a startup with the brand under Just Mayo. Gillette, which is owned by P&G, went after Dollar Shave Club. So again, just to highlight that this is not just a tech phenomena, it is tech sort of encroaching on lots of different areas pretty quickly. Unfortunately, the reality is, though, within most large organizations, the antibodies to innovation are pretty strong. So there's probably less than 5 organizations, and I'm probably being generous by a couple there, that are large and equipped to experiment at the volume required to innovate. So a lot of the reasons for the inability for big companies to innovate comes down to a few things. There's process impediments. They don't really have a structure to identify and develop experiments. You can't really focus group your way to innovation. That's just not the way it's going to work. Focus groups may be great for incremental innovation, but disruptive, discontinuous innovation is going to be tough to get from focus groups. Culturally, there's impediments. So the experiments are their end state tends to be failure, and that's not often easy to do in large organizations. Resources become a problem. To do the level of experimentation that might be requires significant money, and if you're especially a public company that has that has the joys of quarterly earnings releases that may be difficult. And then ideas is another issue. So some of the best ideas don't always come from within large organizations. These organizations aren't always well suited to develop them. So some of the impediments that the big companies have, I think one of the other big ones they have is that large organizations tend to worry about other large organizations kind of to unhealthy levels. So when you think about, if you think of yourself as Godzilla, it is likely that King Kong is not going to kill you. It is actually a death by 1,000 cuts. So there's this army of emerging players that are going to attack legacy players, and that we see attacking legacy players at an individual product and service level. And so one of the things that we've kind of become known for are these unbundling graphics. And so, this is an example, one of our first ones of Wells Fargo, looking at each of their products and services and which startups are attacking each of them. So, it is, again, just to reiterate this idea of death by 1,000 cuts. It's not just the U.S. thing. So we looked at HSBC. There are plenty of internationally based startups in Europe or Asia that are also attacking these companies. So I think a lot of folks think that innovation is a U.S. kind of Silicon Valley-led thing, but it's become pretty distributed at this point. You have Apple iOS, folks going after each of their kind of offerings. You have FedEx, so, Starwood. We sort of tongue-in-cheek put out a disrupting walking infographic that looked at just personal transport devices. So even things like that. The automobile obviously is a big area for this type of disruption. B2B services, payroll services, Honeywell, so looking at everything from the smart home to other industrial applications that are happening. Procter & Gamble, as we discussed earlier, Craigslist, the list goes on. So I think the main point there is really that this is not a tech-only thing. That sort of adage, I think, coined by Mark Andreessen of software is eating the world is quite appropriate. So what's a corporation not to do? Let's talk a little bit about innovation theater. For those of you who are fortunate to be in the U.S. and go to the airport occasionally and see our TSA, Transportation Safety Authority, I believe, you'll see kind of some of the measures that they put into place, which are sort of security theater, right? And so this was a great sign at an airport about snow globes now posing a significant risk to our safety. From an innovation perspective, folks do similar things. So optics that sort of tend to make you feel innovative, hire a chef, make up sort of interesting, crazy titles. Innovation Sherpa or Digital Prophet are two of our favorites. The open floor plan is a big one, having an Xbox. Talking incessantly about embracing innovation, visiting Silicon Valley, kind of doing the pilgrimage there. And this is Dilbert kind of always captures the sentiment better than anybody. So as you can kind of see here, launching an accelerator. So this has become the new kind of flavor of the year, I suppose. So we're going to launch an accelerator. We're going to get an article in TechCrunch, and then we're going to sort of declare mission accomplished. Pretty difficult. Launching an accelerator is not a bad idea, but there's a significant investment of ecosystem development, brand development that you need to do. Otherwise, you're just attracting sort of tier 3 startups, really. The good old casual dress code. We don't wear suits. We wear khakis. That will somehow make us innovative. And then, hiring somebody who sort of leveled out at Google or Apple and bringing them in to head up your innovation efforts, as if just the having that on your resume makes you qualified to lead innovation at a large organization. So, these are the things to avoid. We're obviously being a little bit tongue-in-cheek here, but these are all rooted in truth. There are companies that do these things pretty regularly, and these are the things to avoid. So next, kind of talking a little bit just philosophical or culturally, with startups, I think it's really about seeing possibilities and not problems. And so we're going to talk a little bit about the yes and approach. So there's the sort of head in sand dismissive approach to thinking about startups, and this is sort of Brian Moynihan, CEO of America's largest second bank, basically dismissing robo-advisors by saying that their clients aren't rich enough for the banks. And this is maybe true today, but again, if you think about disruptive innovation and that that kind of trajectory I showed you earlier, the not rich enough of today will be the plenty rich tomorrow, and so not worrying about them today is probably not the best strategy. But the reality is most startups fail, so this is kind of the startup funnel, right? And so a bunch of companies get seeded and very few come out the other end as being successful. It's not an unsafe statement to say that this, when you see a startup, that it will likely fail, because it probably will, but that sort of misses the point, because tons of startups that might impact your industry will fail. And so these are a bunch of big names from the dot-com boom in the e-commerce space that all flamed out. The reality, though, it's not these guys that you need to worry about. It's the 2 or 3 that survive. And so the next page kind of shows you Amazon and eBay that really kind of, even though there were tons of casualties in e-commerce, these are the 2 that have become really disruptive. When you think about, if you are a traditional retailer, Amazon is clearly a problem for you today, and but you'd have seen this many years ago and maybe done things differently if you'd looked at Amazon as being a threat and not just a fun, silly experiment. I think one of the things we see increasingly is that incumbents tend to focus on why they're better, and there's no, and this is true, most of them are. They are real companies with real revenue that are massive, with massive market caps. And so they tend to focus on why they're better and why startups will fail. And they'll say things like what you see on this page, hey, regulatory burdens are too high. Startups won't understand that. We have client trust. A client won't trust a startup. We have certain advantages. So this is all fine and well, but again, that misses the point. Dismissing startups as sort of intellectually lazy. They are, again, vast majority are going to fail. So really what you have to do here is talk about yes and, think about the possibilities. So, I think this approach of yes and is really important. So I had many years ago kind of taken an improv class, and this was sort of one of the fundamental tenets of improv was you could never sort of say no to a scene. So if somebody set something up, you always had to go with the flow. You couldn't say, oh, that's not a good idea, let's start over. You had to just say yes and kind of expand on it. So kind of homework number 1, and you'll see this in the deck when we send it out later, so you don't have to scribble all this down. For all of you who've dismissed a startup or an emerging industry before, kind of go back to it and actually think about the reasons it might work and become successful. So, if it was robo-advisors, or if it was Dollar Shave Club, or if it was some other business that's really specific, obviously relevant and specific to you, find the reasons why it could succeed. I think, being positive about startups pays dividends. Dismissing them out of hand, again, it doesn't necessarily, it's not a very productive use of time. And really, as I mentioned earlier, this is all about forcing that sort of cultural mindset more than anything. I think optimism leads to innovation, and sort of this idea of yes and is inherently optimistic and forward-looking. So, so that's kind of a little bit of the softer stuff. So let me jump to kind of process now. So how do you use startups to innovate? So how you use them is really a function of kind of your organizational personality. So we talked to lots of organizations. They kind of fall into just loosely or roughly 2 buckets. There's those that are focused on defense and those that are focused on offense. And so the discussion when we're talking to a defense-oriented organization is often they're trying to get buy-in within the organization and some momentum around doing something, that addresses kind of the challenges that they see down the pipeline or in the future. It's about identifying disruptive threats, analyzing markets to identify opportunities, and understanding competitor activity. A lot of organizations start on the defense side and they make the case internally. You have to syndicate these things often up the chain, and then they move to the offense side. And so the discussion when we're talking to companies that are offense-minded tends to be, they've realized the world has changed. They're thinking about technology, or they're thinking about startups in a way that is really underpinned by the idea of how do we gain share, how do we win customers, find new markets, how do we move faster. often they do talk about sort of disrupting the core business. And then ultimately these are going to lead to actions, right? Build, buy, or partner. So offense is a little bit more action-oriented, kind of externally, I'd say, but defense is often where things start because you need to build that case. You need to get people in the business units who are running the day-to-day excited about and understand and on board with why it makes sense to pursue this effort. So the process of innovation, kind of, really high level, and for those of you who are on the phone, you're going to all be at probably different stages of this. So I'm going to start kind of as if you are at sort of ground zero, but you may be further along. So the first thing is market assessment. What's going on, which markets are hot, how should we be kind of just organizing the world. From there, you've identified maybe a handful of markets. Then it comes into market mapping. So within a particular market that you think is promising, what are the different business models, technologies, solutions that have come up, and sort of understanding that world. Finally, it's sort of identifying winners. And so you can identify winners, companies that are startups, for instance, that have momentum, that are going in the right direction, and that may then ultimately lead to some action. So you might choose to copy them and build it. You might choose to buy or invest in them, or you may just choose to partner with them. But again, trying to figure out which of those companies and models are gaining traction, and then ultimately making a decision based on that. So I'm going to kind of break down each of these steps in the next bit. Again, just to reiterate, I think for most corporations, innovation is sort of random, right? At its worst, it's a buzzword. Often there's no process. It's the term we like to use internally is that there's a lot of reliance on what we call data janitor work and anecdata, right? So it's a lot of gut instinct, Google searches, and guys with MBAs, and I say that tongue-in-cheek. I'm a Wharton alum, so nobody with an MBA, please take offense. So market assessment, we'll start with this. This is kind of, this Wayne Gretzky quote kind of says it the best, right? You don't want to skate to where the puck is, you want to skate to where the puck is going to be. So how do you do that, right? The method today is kind of, if I take the guys with MBAs approach, is pundit-driven sort of market assessments, which are notoriously bad, right? And so the phrase of economists have predicted 10 of the last 3 recessions kind of comes to mind. So here we're looking at a variety of predictions about the drone and virtual reality markets, and we see virtual reality at 150 billion by 2020. We have it at 5.2 billion by 2018. 4 billion. It's just really all over the place, right? So how is this really the best way to do it? We think the best way to sort of assess markets is using data and not decibels, right? And so there's a few ways you can do that. You can stalk the competition. You can use data to identify industries with momentum, or you can just follow the money. And so I'll kind of show you some high-level examples of how you do that. So this is stalking the competition. I had, when I was at American Express, written a book about resource allocation, and the idea being that the best way to understand strategy is to just look where you put your resources, right? So if I'm talking to you and I'm interested in what your hobbies are and what your interests are, you could either tell me, or if I could see your calendar and what you do on the weekend, I'd have a pretty good idea of what your interests really are. So there's what people say and what they do. And so it's the same thing for corporations. You can listen to their quarterly earnings releases and the talking points and all of the kind of very scripted points that they want to make, or you just look at what they're doing. So look at what they're investing in, who they're acquiring, who they're partnering with, and you get a really interesting view on their strategy and so what markets they're thinking of. So this is an example of a variety of insurance companies, and so you see kind of USAA, Travelers, etc., and the different sort of buckets that they're investing in. And when you peel this back a little bit, you kind of see USAA and where it's been sort of making moves in various areas of price comparison or lending or wealth management. And when you compare it to somebody, let's say like AXA, where it's price comparison, thinking about dynamic pricing, again, so you get a sense for kind of the markets and the areas that a competitor or an incumbent is interested in. That's one way to kind of understand where there might be opportunity. The other way is looking at a variety of non-traditional signals that you take together to determine which markets are growing or declining. So we've built something, and you can see a link at the bottom, called Mosaic. So we pull in news and social media chatter and sentiment. We look at hiring activity, look at, of course, financing and exit volume. And so when you smash those things together, you get this, what we call a mosaic score that looks at how healthy an industry is. And you can think of it, you know, if you're in the States and you're familiar with a FICO score, it's kind of a FICO score for an industry. So it's a really quick way, a shorthand of seeing what's trending up and what's trending down, sort of, and it's real time, and it's highly data, or purely data driven, so it's not kind of pundit driven at all. The other way is to follow the money, right? And so this is, again, taking a look at insurance tech just as an example industry. You know, how robust was the investment ecosystem in 2010, which is that sort of little network map you see to the left, and then over to the right, you see kind of how the investment ecosystem has expanded. So, so you can see that, okay, you know, just there's money rushing into that market. That's a great way to just see that there's activity in a particular space. You can also just look at, you know, financing and exit trends. So this is cybersecurity. You see the funding trend. You know, we often say that not all investors are created equal. So, you know, maybe you want to look at, well, what's the smart money doing? And so this is an example of kind of Andreessen Horowitz, and this is this heat map that we've built that looks at what were they investing in historically, let's say in the 2010 to 2012 time frame, and as you fast forward to today, you know, what do you see them investing in? And so just to give you a little bit of an understanding of what these heat maps are illustrating, the darkness of the blue here is the amount of funding, the size is the number of deals, and so you see kind of cybersecurity in the upper right on the lower heat map kind of shows that they're doing lots of deals there. So, you know, cybersecurity is booming, but then smart money like Andreessen is also getting involved, which is an indication from a market assessment perspective that there might be something here. Of course, you want to peel that back further, and we'll kind of walk through how to do that in the next bit. Next piece is market mapping. So you've assessed the markets, you found maybe a few that look promising. Now what you want to do is sort of build a market map. And so a market map, just to define it, is kind of this illustrative display of the positioning of a product or service in the market, you know, and you can break that down by technology, customer, or business model, you know, with the aim of identifying and sort of implicitly suggesting areas that are areas of market penetration, and then for corporations, untapped areas for expansion. So there's lots of different ways to illustrate this. We have our sort of ways that we like at CB Insights, but we've seen clients do it differently. You know, you have this market map, so this is one of the payments, and so this is kind of breaking it up by use case. So you see point of sale, and you see Bitcoin, and you see all sorts of different use cases here. This is another way to display the market, kind of the unbundling graphic that I mentioned earlier. So this is FedEx. And then this is probably one of our most popular is kind of the periodic table. So again, you know, it really doesn't matter how you illustrate it, I think, but coming up with some visual way, I think, is important to illustrate a market. It's much easier for somebody to respond to this. We've had a lot of success with clients who are on sort of in the defensive posture when they see the unbundling graphic and they show that to senior execs. That has a very immediate reaction from them. You know, an Excel spreadsheet and you know, hey, there's 333 startups in our space that have raised $2 billion, you know, might make the case, but again, seeing it, I think, in a visual format has helped quite a bit. You know, the market mapping exercise isn't hard, but here's where, you know, organizations waste a lot of time and talent on data janitor work, right? And so this is part of the reason we started CBI, John and myself, was really doing exactly this in our old group, and it was our team that was doing it, was, you know, it was going to Google, hey, what's the list of payment startups, right? So my boss would come in, say, hey, can we figure out, you know, who's doing what? I'd tell one of the analysts on my team, and this is basically what they do. They go to Google, they'd try to piece this together, and then the next step was this miserable Excel spreadsheet, right? And so they'd be filling in this Excel spreadsheet. It basically meant staying at the office late with the implicit understanding that this was going to be outdated tomorrow, and your title was analyst, but you were actually spending only 10% of your time doing actual analysis. So there's nobody ever in the world who's like this job. So so this is kind of the data janitor work that you know, I think we try to get rid of, but I think this is part of the problem with market mapping, is that we spend too much time on the janitor effort and too little time on the analysis. So homework number 2, kind of unbundle thyself. So, list your products and services. If you can use your website or some sort of image, that would be great. Identify all the startups who are attacking each product and service. Remember to include even the ones that you think are stupid, the yes and approach, let's recall that. Ultimately, and we'll talk about this in the next step, study those gaining traction, look for themes among business models, amongst how they're marketing themselves, etc., the demographic they're going after, and then send me what you come up with, and I'm happy to chat with you about, give you my thoughts on it. Again, why are we doing this? Help you understand the landscape in one effort. You're going to need to refresh this over time. Obviously, the world is not stopping, and new companies and new technologies are taking form. And then again, I think the second bullet's the most important here, is that we've seen this catalyze action in a lot of organizations, especially those that are in sort of defense mode. It's, again, that visceral view into threats that tends to get leadership motivated. So I think spending some time on here, especially if you're trying to make the case for doing something, is worth it. And if you need our help, let us know. Final step or not the final step, the third of 4 steps is identifying the winners. So which startups are breaking out? You created your market map, you identified hundreds of startups, but you want to identify the winners, because it's their products, their technologies, how they're marketing that you should analyze, and they're either your threats or your opportunities depending on your perspective. So let's take that list that you created using Google searches and try to identify the winners, right? And so you Googled, I'm just going to cheat here, so I use CBI to figure out how many payment startups there were in the last year. There were 525. Let's say you found all of them through your work using Google, which there is 0 chance of. A lot of companies go back to the 3 Gs, right? They go back to, well, how am I going to assess these 525? Gut, Google, and consultants. So let's take one example. Let's just try to analyze one company. So we're going to analyze Stripe, and so we're going to look at its web traffic. I'm going to pick a few measures that are sort of intuitive. I'm going to go see, are they hiring? Maybe it gives me a sense for momentum, and are they hiring in sales or certain key roles that indicate they're scaling up. You can try to do that using a site like Simply Hired. You'll have to strip out, obviously, irrelevant results, as you can see here. We'll try to get a sense for people talking about them maybe on social media. Is there sentiment? So you can look at some tools here. You try to track news volume, so you go to Google News, and then you just have to repeat that 524 more times. So that's kind of the process to whittle that list down. This is, again, where we think using data on startups. There's no SEC filings, unfortunately. Like, there's no 10K and 10Q quarterly releases that you can use. So how do you look at startups, without that, given they're opaque? And so we've built some models, again, with NSF funding to look at momentum and market health and the money, kind of the burn rate of companies. And so you get a sense for what that looks like, and so as a result, you can look at hiring activity across companies very quickly, and then you can just filter by mosaic. And so I did a filter on that 525 and said, show me the top 5% who'd raised less than $20 million, and I'm now left with 23 results, right? And so now you have a really long list, and you have a much shorter white list of companies that could be interesting to you. Now, whether you're thinking about partnering or building or buying, that's sort of the next step. But at least you now know who is breaking out within that list. So then you have that list, then it really turns to build, buy, or partner. So kind of, again, there's no universal truth here. Depends on appetite for risk. It depends on your own kind of what works for you. On the build side, there's things that corporations we found are very good at, and that is what we call flavor innovation, right? So kind of an example of the pumpkin spice Oreo as one. What's hard is, and so what you can do is copy emerging strategies that have traction. So Schwab launched a robo-advisor, Sephora got into the subscription box business, Gillette, which I'd mentioned previously, got into the shaving club game and launched their own. But what we see is that the disruptive kind of moonshots tend to be harder, right? There's Google and Amazon are very remarkably good at it, but they are also really in a category of 2. and maybe again I can add 3 more to that to be generous, but most organizations just don't have the capacity or the desire to take on these moonshots. So building may be harder for the disruptive innovation. Partner, really the question here is, are you really accessing innovation, or is it just good PR, right? And so, this idea of joint value creation, right? And so we get inquiries from big corporations sometimes who say, hey, we don't really have money, but we'd like to do something that will deliver quote-unquote joint value creation. This is generally shorthand to be a big waste of time. So I think as a corporation, if you're going to partner, make sure you have skin in the game. That means money. Partnering in exchange for equity. We did this at American Express when I was in the venture group. I think it has mixed results. You take the example of Starbucks and Square. It was a 25 million investment by Starbucks, but it ultimately resulted in a much larger loss to Square. So if you're going to invest, and try to pile on with warrants and other things, or do a partnership and try to usurp value in some other way, maybe take a look at whether it makes sense to partner. I think you should partner on the merits of what that startup has, and not on the basis of some financial return that you might get, just because for most large organizations, the return that they're going to get from some startup partnership is going to be small from a financial perspective. From an innovation perspective, the dividends could be large. Of course, there are people who do it well. So I think Nordstrom is a great example, and you can see kind of a case study we did on them. So just looking at how they've partnered, whether it's partnering, investment, etc., but they seem to have gotten a good recipe down for identifying as well as ultimately executing upon partnerships. Walk before you run, so don't make it complicated. I think, step one is, hey, does this partnership make sense? Can we make the startup more valuable, and then will the startup help us do something better? Before you try to make it crazy, complicated, with exclusivity and all sorts of things, I think that becomes something to wait on. So, and then finally, you have your buy option. So do you kind of take a nibble, which is an investment, or a full bite? Corporate VC is obviously booming, so it's in every sector, tech to healthcare to finance to energy to media, and so you see kind of, tech, you see healthcare, you see finance, energy, insurance, media. So it's really kind of across the board. Telecom, even your larger industrial kind of concerns are also getting involved. So, and have been involved, many of them for many years. So Siemens as an example. It's not, again, this is not a tech thing. This is really all over the place in terms of where corporations are trying to get involved. Corporate VC, as you may know, is kind of on track for record highs in terms of deals and activity. Corporations are sitting on lots of cash now, and that's one of their competitive advantages from an investment perspective, is that they can help organizations, startups out because they have just more resources than venture investors do. They participate now in increasing number of VC deals, and the number of kind of active corporate venture units is actually increasing. And this is actually understated, because we've been very precise here in terms of only separately delineated corporate VC units. If we were to include corporations that make minority investments off their balance sheet but that don't have a separately kind of organized venture team, this number is actually much, much larger. So they're sort of really stepping up their game. And unicorns, nothing that we do at CB Insights is complete without at least one mention of unicorns. Corporate venture arms are actually have had quite a bit of success getting into and backing some of the unicorns. So that's kind of on the build or the buy side of things. Investment or acquisition. So acquisition, I didn't touch upon it too much. We just released something last week about acqui-hires. So for those of you not familiar with the term, this was larger incumbent organizations buying a startup for its talent. That activity's dipped off quite a bit, and we'll send that out to everybody so you can see that. But I think part of the reason for that is that maybe valuations have gotten a little bit out of whack. And I think the second thing is that the reality of an entrepreneur or an entrepreneurial team wanting to see its product get shut down and just go work in a large corporation is maybe just sort of antithetical to what an entrepreneur wants. So, so we've seen a drop-off in sort of acqui-hires, which were really popular a few years ago. You know, M&A has also tended to be at the smaller end of the spectrum as of late. Again, that might be due to valuations, but you know, some interesting kind of things to keep in mind from a buy perspective as well. So that's kind of the 4 parts of the process, right? Market assessment, market mapping, identifying the winners, and then kind of your build, buy, partner decisions and some ideas around that. I think the one other thing, and it was on the initial kind of visual, was networked ecosystem development. And so I think this is where a lot of organizations don't spend as much time. So they do the press release, but they don't really spend a lot of time building out their network. And so you'll see a link kind of at the bottom of this slide where it says full lesson here. There's sort of a whole lesson we have on how to build your network out using data. But the idea here being that you really have to actively engage. And so this old idea, and we hear this from corporations a lot as well, we have access to deal flow. You don't, right? Outside of 10 elite firms, like proprietary deal flow is kind of a thing of a bygone era. So you really have to focus on finding and getting access to deals and smart people. And so you can do that in a few ways. You can look at, you know, who's in the ecosystem in areas of interest. So again, if I just go back to payments, which is my roots, you know, who's investing in payments actively, you know, going and targeting those folks for, you know, from an ecosystem development perspective. I think that's a really smart strategy. You know, targeting who is working with your competitors. So if I was still at Amex, I'd be looking at who's investing with Visa and building relationships up with them, and who is, you know, this kind of shows a syndicate view of investment, who invested in companies before Visa. So again, those might be folks that I want to talk to because obviously they have sort of the ear of a competitor here. So I think, you know, there's a lot, yeah, this is a whole separate webinar on ecosystem development, but there's a lot you can do there. So with that, that is everything that I had. There's a bunch of slides in the appendix around corporate venture and M&A data that you'll see. But if you have any questions, I'm happy to take those. We'll look through the queue right now and pick a few right now in the time we have left and try to get to others, you know, maybe afterwards. Okay, so one question that's come through is, do we think we'll see more investment from international corporates like Alibaba? Yeah, absolutely. I mean, I think it's actually already stepped up significantly. I would say that it is the corporates who are the most aggressive are either, and I'm generalizing, but the data I think will prove this out, are the US and Asia corporations. We find the European corporations are not doing as much, but Asia definitely, the Asian corporates are doing a lot on the investment side. They are buying as well as building and sort of partnering, so incredibly aggressive there. You know, a lot of the mega rounds that you see in the press are often in Asia, are often or almost always have some corporate involvement. Do you think it's important for corporates to invest in their own verticals? Yeah, I mean, I think there are a handful of, if you're, you know, if we're talking about investment from a venture perspective, there are a handful of corporate venture firms that really act like traditional VCs, and there's not many of them. I'd say, you know, Intel Capital, Google Ventures, Qualcomm maybe to an extent, but I'd say the ones that but those are unique, and I don't think that's a model that is going to work, at least initially, for everybody else. So I think investing in kind of things that are at least adjacent to what you do is important. It'll, I think, help with, what we see is it helps with getting alignment and interest from the business. That doesn't mean just incremental innovation, though. So there was a presentation we'd given last week to insurance executives, and I think what we were finding was that insurance companies were increasingly investing in startups, but they were really investing in things that made their core business more efficient and not in things that might actually totally disrupt their core business, right? So, you know, if you're an auto insurance company, you know, that could be investing in platforms that help with pricing of auto insurance, right? So that's could be great from a distribution perspective. It's not to say you shouldn't do that, but what they weren't doing was necessarily looking at pay per mile insurance or completely different underwriting and risk models related to insurance. So investing in your own vertical is good. Investing maybe in areas that might be a little further afield could be good as well. Do you think corporate should invest for strategy or profits? So I guess the glib answer is all of the above. I think if you're going to consistently lose money when the economy turns, that's going to be one of the first business units that's going to be restructured or have an organizational realignment. So I think you want to at least consider the idea that there's going to be some, I don't know if profits is the right word, but there should be some direct, hopeful measurability of what the effort has done, right? And so whether that's a business unit has cut costs or has become more efficient or has distributed more product as a result, you should get credit for that in some ways. But I think there does need to be some bottom line impact, especially in the beginning. I think over time, after you've had some success, you can you have a bit more latitude. Let's see. Wow, there's lots of questions. Are there corporations in specific verticals that are at most risk in the near term? So I think there's a lot of verticals, right? So I think, some of them probably folks expect. So I think within financial services, kind of across, and financial services is a very broad umbrella, but insurance is an area that we're seeing an incredible amount of innovation happening in now. Payments still has a long way to go. Traditional banking, wealth management, so kind of the whole umbrella of financial services, there's a lot of room to grow, and there's a lot of risk, I guess, or opportunity. Again, this just depends on your perspective. Auto is the other big one. I think if you want to figure out if an industry is at risk, I think there's a few things that you can look at. So I don't want to rattle off a bunch of industries, but I think you can look at, are there unusual suspects entering that space? So if it's, is like in payments, for instance, when I was at Amex, it was a while ago, so we used to think of, Visa and MasterCard and Discover to some extent as competitors, and, Citi and B of A, and we'd think about them, but we didn't really think about the tech players. We sometimes thought of PayPal, but now, I bet you everybody's talking about Google and the telcos who are getting involved in payments. So I think you want to look for a messy kind of landscape in terms of the types of organizations entering. And then you want to look at where the pace of sort of innovation has accelerated. So have there been notable exits? Are there some emerging companies that are kind of getting traction? So those two things combined are often a good way to see if, messy landscape, fast moving are the ones that are most at risk, because often the incumbents there can be blindsided by it. They sort of understand it, maybe theoretically or in an academic sense, but don't do anything about it. Let's see. What corporation role governs? The biggest roadblock to building a truly innovative corporate culture. So it's a loaded question. I think the big thing is that I think corporations are really good at knowing, right? So they know what's happening often. They have a pretty good sense for like what might be happening in the market, and what often the roadblock is actually doing, right? So, hey, we have used CB Insights and we figured out what we need to do, and we've got action. We've got sort of momentum, and then it's really like, well, now what do we do, right? And so I think you have to start with the knowing part. So it's not to say that that's not important, but the ultimate roadblock is you have to take some bets, and you have to realize that many of them aren't going to work. You're not going to bat 1,000 on these. So I think that's one of the big things to be, that's probably the biggest impediment, is just analysis paralysis. I'd say the other thing is sort of death by committee. So I'm giving you kind of two, is, you want to, it's this innovation effort. It's not a democracy, right? So not everybody on the executive team should have a vote. People's feelings might get hurt as a result, but you don't need everybody to chime in. You want the people who are informed and whose maybe businesses are impacted to chime in. But if not everybody needs to. I'd say one of the things we did at Amex, which was not good, was we had sort of any veto. One veto could kill an idea. Like, absolutely don't do that. So I think that was clearly sort of badly structured on our part when we were kind of going through things. I think one of the other things, now that I've kind of gotten started, folks will set up their innovation efforts, and they've gotten capital, they've gotten some resources, and we're working with them. And what is the reality is they didn't put an A player in charge of the innovation effort, right? So they put somebody who was plateaued at the organization, who's been there a while, and it's sort of their special project. And that just doesn't send the right message to the rest of the organization, right? It says, hey, innovation sort of where we're doing it in name and not in practice. And so I think that becomes another important thing. If you're building a corporate accelerator that actually worked, how would you go about it? It's a really good question. I think I'd spend a lot of time up front building your brand up in the startup ecosystem, right? Because I think what happens with corporate accelerators today is that they get tier 3 deal flow, right? They get the companies that don't get into the tier 1 and even tier 2 accelerators. And so that's not what you want. You want the best entrepreneurs and the best ideas. And so part of that is being part of the ecosystem and building up your brand and being viewed as somebody who is not just doing it for theater purposes. And so I'd say before you start that, it's really kind of building relationships in the ecosystem. It's getting to know companies. It's maybe offering value to companies in exchange for nothing beyond maybe the value your business gets back from maybe efficiencies or benefits that startup gives you. But I think like if you look at venture investors who've done very well, they play the long game, and looking at 6 months and what's our track record a year out is tough, and that's a inherent conflict in large organizations, because you have I remember having quarterly and annual goals, and budgets got set every year, and so this is there is a conflict there. But I think before you get to Accelerator, it's really kind of understand the ecosystem, create some credibility in it, and then maybe think about an accelerator at some point. So we have 4 minutes left, so maybe I'll talk a little bit. Take one more question. What role do employee incentives play? So yeah, they play a big role. So people pay them. People do what you pay them to do, and so I'd say one of the employee incentives or one of the kind of structural impediments that we see at big co's is around IP. So often it's, hey, if you propose an idea as part of our innovation effort, the company now owns it, right? And so we saw this, I've seen this now at many clients, I've seen it at Amex. There are entrepreneurs in your organization without a doubt, but the true entrepreneurs are probably thinking about leaving to pursue some of those ideas. And so there's no way they're going to give you those ideas if they know that, down the road it's going to buy them a lot of heartache and grief if the company decides to come after them. So, I think beyond incentives, some of the things are just structural. And then I think ultimately it's about the reward, right? So if you get past that IP impediment and you you say, okay, hey, the IP is free and clear, whatever, whatever you determine that makes sense for you, and to foster that, what's the reward, right? Hey, if we build this business, and it takes many years, right? So that business isn't going to be $100 million or $1 billion business in a year, but over time, if that becomes a big business, what's my reward, right? Is it, sure, a title might be interesting, but like, am I going to see, is there some potential for meaningful economics from that back to the team that built it? if it's just, hey, instead of the 5% raise, you're going to get an 8% raise this year, and your bonus is going to be 12K instead of 8K, that's not going to get people excited, right? I think people want to know that if they make an impact, they're going to have, that they'll be personally impacted. And this is hard. I think venture units at corporations have a bunch of different ways they try to do this, but, carried interest in things is not necessarily easy and in venture. And then from an innovation effort perspective, it becomes even more intangible. But yeah, I think incentives play an important role. But you do have to start kind of trying stuff, and then you can do these things in parallel. You can start trying experiments, and then at the same time sort of start to get the organization ready from an IP and other incentives perspective. As you also are experimenting. So I know I'm at our time, so I just want to be respectful of that. So thanks everybody for all the questions. I see that there are a lot more coming in, so maybe we'll try to compile them and put up a post or something and get those out to you. Again, questions, tweet at us or email me. I hope that I will get your homework answers soon as well.